We had actually a batch of bad years. If you look back, there was the zero interest rate environment, which is always very bad for insurance and reinsurance companies. We had a lot of nat cat activity. We had COVID, where we paid more than $6.5 billion over the years. We had a war, we had inflation. So huge amounts of things have happened, and the environment has accordingly reacted and is much, much better now. So we're very happy with what we achieved last year and very positive about what's going to come now.
Yeah, just looking at 2024 as well, if I may then. I mean, do you expect net income to still remain at that $3.6 billion figure? And how much can you catch up by way of price hikes right now?
Yeah, so I mean, this year is a particular year because we're going to switch accounting standards, so that mixes up things a bit and increases the risk a bit. But we set a target in December of 3.6 billion, and there's no reason at this stage to deviate from that. But we're confident that we can make it. And the renewal we had in 1st of January, which is important, is about 50% of our business gets renewed across the world, mostly in Europe. We achieved the type of price increases that we had expected in our plan. So at this stage, we feel confident about the targets we have set out.
Christian, lovely to see you again. Some of my price increases from my various insurances are eye-wateringly scary this year as well. Is your industry putting up prices too much, actually, and actually creating an inflationary problem and a bit of a headache for the central bankers?
Yeah, I think it's a very fair question. But in the end, the role of insurers and reinsurers in particular is to put a fair price to risk. And I think we have actually been lagging a little bit in the last few years. With climate change, risks have increased a lot, and you could see it in our profits, which were not adequate over the last few years. And so this is a reaction, a reassessment of the risk. And to a certain extent, what we see here coming is the price for climate change for the first time coming, at the door of regular consumers. So far, this was a very abstract problem, but here you can see the practical implications. So I don't think we are above anything we need for the shareholders to get their adequate returns.
Having said that, when I look at some of your combined ratios, I mean, it's the same as actually, funny enough, in the last quarter, the corporate solutions, for instance, 91.7% combined ratio. These are strong profits, Christian, as well. None of the customers coming back to you and balking at the price.
This, of course, always happens. And, of course, corporate solutions is in discussion with corporate clients. But, again, we shouldn't forget the history. There were billions of losses in the last few years. The prices were way too soft for a prolonged period of time, creating lots of losses. So if you look at it in a time series, I think this is entirely reasonable and justifiable. We're in a free economy and a competitive situation. So if the profits are too high for too long, I think you can entirely trust on the market forces to bring prices back down. But this is a moving average, if you want, and there were really bad years before.
And I hear you, and I'm not trying to bemoan the fact that you're making some good money now, Christian. It's a positive thing, I can assure you. But an ROE of 22.3% is a tasty figure as well. But having said that, you and I have talked previously about the importance of interest rates to your model and importance of interest rates to having extra capital flowing into the insurance sector or not, as the case may be. Are we at a high watermark now of profitability for your sector, given what you just said about concerns about the risks of climate change, and given also, if you twin that with the fact that rates probably have peaked?
Yeah, so I think this is very interesting. Actually, when interest rates were very low, there was, as you know, this search for yield in the whole industry and a lot of attraction to the reinsurance industry, and a lot of capital flowing in, which actually created this negative momentum in pricing and led to the soft market, as we say, where we don't earn adequate returns. As interest rates have gone up, there's, of course, a whole series of investors who see other opportunities somewhere else. Now, this said, for the natural catastrophe business, where I think we need some form of capital market support because the risk is so enormous and there's still a big protection gap, we can see the professional players have stayed in and are still very interested. So at this stage, I'd say the market is pretty in an equilibrium. So last year, there was a lot of panic around the price after the Hurricane Ian. This year, the renewal and the situation is much more, even. There's enough capital to fulfill all the needs of our clients.